Today we're going to talk about who is watching your money. But Jeff, before we get into that, let's do a little background on the baby boomers who've been largely driving the economy for the last, 70 years?
Yeah, close to it. Since the very inception of baby boomers, we've got disposable diapers. You remember Walkmans or Discmans. I mean, they've changed everything they've touched, and money management isn't an exception. Their demands have driven what services investment firms provide. Used to be, prior to the baby boomers, it was like we used to call your father's stockbroker. It was a paneled office downtown. You saw them for lunch once a year, and that was it. As the boomers came into the market and became more affluent, they wanted to be a part of it. We saw the advent of mutual funds and ETFs and those type of products started to proliferate the market.
David, what are they doing now? What are baby boomers doing now in terms of investing?
Well, there's about 10 million in Canada, so I wouldn't say every one of them is doing this, but there is a shift certainly towards more fee-based type of investments, and in addition, an extension of that is discretionary investment management, which is where you basically give your investment advisor the discretion to make decisions on your behalf while you're off traveling and doing your thing, right?
Now this is different, Jeff, from say a few years ago when a lot of these guys wanted to do it themselves with discount brokerages and that type of thing.
Yes, there was a real sense, and this goes back to the baby boomers too. They were educated, they wanted hands-on, and with the internet and everything else, they were able to actually execute trades and trade their own accounts. And you saw the commercials for day trading and everything else. And first the tech crash came, and that hurt a lot of them. And if that didn't do it, 2008, I think, soundly reminded everybody that a little advice is a good thing.
What's this term discretionary trading we hear about?
Well, it's actually, I don't want to confuse that with discretionary investment management. So discretionary trading refers more to acting and buying and selling securities without the consent of the client, and that's where an investment advisor can get into trouble if they haven't had prior written consent. Okay. Whereas discretionary investment management is developing an investment policy statement with somebody who's licensed as a portfolio manager or investment counselor, and the licensing requires that you have to act with a fiduciary duty, which means you have to act in the best interests of the client and make decisions that would be in their favor.
That makes a lot of sense. Okay, Jeff, I guess, and if people have any more questions, they can go to your website.
They certainly can. Yourlifeyourplan.ca.